Good morning.
Morning, how are you?
I'm all right, thank you. Thanks again for doing this. As I said to you earlier, I understand it's a holiday in Japan, and so we're very grateful that you've taken some time out to talk to us. As usual, if you wanted to just kick off with a sort of 5-10 minute introduction to what you're trying to do with the fund, please.
Sure. Well, the JPMorgan Japanese Investment Trust is the largest dedicated Japanese investment trust. It is a member of the FTSE 250 and is the only dedicated Japan investment trust that is both gold rated by Morningstar for the process and also has 5 globes for sustainability. In a nutshell, what we're trying to do is be at the heart of Japan's new growth and be the premier vehicle for investing into Japan. And the key points are that we are all based here on the ground in Tokyo. And then the way that we invest, we're looking at high quality businesses that will compound earnings sustainably over the long term. And when we pick stocks, we are long term and high conviction, and we adopt a very clear growth and quality approach. And we're also unconstrained. So if we don't like stocks and sectors, then we simply don't own them. And if you look over the last 10 years, investing in this way has led us to outperform the index by over 1.8% annualized. So you go on to the next slide, you can see the pictures of who we are. So we've got 25 people based on the ground in Tokyo. We have an average industry experience of 18 years. And we've worked on average at JPMorgan for 13 years. So it's a team with great longevity and experience of the Japanese market. And not only do we have this team based on the ground in Tokyo, but we also have JPMorgan asset management analysts all over the world, which can be incredibly valuable, particularly because in many areas, Japan is somewhat lagging behind global trends. So you've got that local knowledge combined with that kind of global insight can be incredibly powerful. Looking at how we invest on the next page, the first and most important question that we want to answer is this a business we want to invest in? Do we want to own this company in the long-term view? So we never start off by saying, oh, this is cheap, could we get it into portfolio? Like, we assess and the quality of that business and do we think it makes sense on a 3, 5, 10-year view? And after that, we go on to look at the valuation. When we rate companies, we give them a rating which is either premium or quality or trading, depending on how we see the prospects. In Japan overall, we give the lower rating trading to 75% of companies. But for the trust, we have completely the opposite structure. So it's dominated by premium and quality companies, what we think are the very best companies in Japan. I think it's easiest to talk through an example, which you can see on the next page. Kientz is a company that makes sensors. It has been the biggest position in the trust for over 12 years now. So, we really want to find winning companies and back them for the long term. It's a great example of the kind of new growth that we see Japanese companies offer. So whereas people tend to associate Japan with things like cars or banks or consumer electronics, actually there are completely different areas where we think Japan is very strong. Actually, there's an article in The Economist this week pointing to companies like Kientz and Fast Retailing, which owns Uniqlo, which are very big. In fact, Kientz is the second biggest company in Japan right now, but are not generally well known. And the reason why it fits so well into our framework is firstly because it has outstanding economics, has very high growth rates because we see more countries automating, more industries automating, and as wages go up globally, and also there's more tension with China, we see those impetuses only kind of get stronger. It's a very profitable company. It makes an operating margin of over 50%, which probably makes it the most profitable industrial company anywhere in the world. it has an extremely strong balance sheet. We're talking billions of dollars in net cash. It has very good duration in that we can't really find a strong competitor to what they do. And not only that, but it is also increasing its market share. And when we come to look at its governance, it is quite unusual in Japan that its employees are heavily incentivized. So you can see on the top right chart there that it actually pays its employees probably double what you get at any other machinery companies in Japan. And if you look on the bottom right, the consequence of this is that over time, earnings have continually risen or estimates continually gone up, and the share price has broadly tracked that over a very long period of time. That's basically what we're trying to do, to identify winners and hold them for long periods of time, which is reflected in pretty low turnover in the trust overall. So if you look at how we've performed on the next page, I've been the lead manager of the trust since 2010, which I think maybe makes me the longest serving manager of any of the Japanese investment trusts. So you can see the record back to 2010. We've done well in the long term, but the performance is volatile. We have a very high active share. We look nothing like the benchmark. I think absolutely we must avoid certain areas and really focus on the areas of high conviction. But you can see that performance is volatile. So it's important to understand when we do well and less well. So we just look at a couple of examples. 2020, the pandemic year, in the beginning, the companies had no sales, but because our companies tend to have very strong balance sheets, we did well. And also because we're looking at where companies' industries will be in 3, 5, 10 years' time, we were already positioned for things that would, there's going to be more e-commerce, or there's going to be more cashless payments, or there's going to be more automation. We already owned all of those areas. Similarly, we do well when there's a kind of low growth environment or steady growth, and companies that deliver on earnings do well. And we saw that in 2019. But you can obviously see 2022 is a very tough year, certainly the toughest year that I've had in my career as a 20-year career managing Japanese equities. And broadly speaking, that was because, I think you alluded to this earlier about how interest rates have gone up and how that's affected valuations. But broadly speaking, there's no issue with the fundamentals or what was going on at the companies we own, but there was a big de-rating of those companies. And although people tend to think 2022 was a year where unprofitable tech companies did badly, actually, in Japan at any rate, it was the most profitable companies with the strongest balance sheets and the best free cash flow and the best industry outlooks and competitive positions. This is the group that de-rated. And if you look at the next slide, what it means for the fund overall is that it trades on the lowest PE that it has really for a number of years. Yes, it's a premium to market. We get much higher return on equity, much higher growth, much stronger balance sheets. And just to highlight another couple of the features of the trust, on the bottom left, you can see we go across the entire market cap spectrum. We really want to pull the levers of the investment trust structure. And, if there's opportunities at the less liquid end, then absolutely we're happy to have them. You can see our active share is 90%, so look nothing like the benchmark. And on the right-hand side, you can see that we have much higher exposure to what we call premium and quality companies, the very best companies, compared to the index. In fact, it's the complete inverse. Just briefly looking at the top positions or what's actually in the trust. I think first thing to say on the bottom right is when we don't like companies or sectors, we will just have zero weight in them. I'm not looking for us to buy the least bad companies in certain areas, but when we can find great opportunities, we're happy to absolutely back them. So I talked about Keyence, but when we think about the new growth that some companies have, you take an example like ASICS, which is a company that lost its way a few years ago, but is the global #1 in running shoes by people who run a lot. New management came there in 2017, really driven their margins higher, but a long way to go and a long way still to push on things like increasing the number of sales outside of Japan. It's this type of very strong brand that we are really thinking will be the big drivers of Japan in the future, rather than those things that people associate with the market. And to look at it another way on the next slide, you can see very strong themes within the fund. And these have been very consistent over a long period of time. This is exactly what you get exposure to with the JPMorgan Japanese Investment Trust. So areas like digital innovation, it's astonishingly still only roughly 11% of retail sales in Japan are online. That is extremely low relative to the rest of the world. Or still many processes in Japan are using paper or fax even, and we're replacing them slowly, but we're behind the rest of the world, and that creates huge opportunity. I've touched on automation with Keyence, but we also have these global strong brands like Uniqlo or like in computer gaming, where over 20 of the top 50 selling computer games of all time are made by Japanese companies. We try to look at things like the demographic change, which is clearly an issue for a lot of Japanese companies, but there are a few companies for which it is a very strong, powerful tailwind, and we only need to focus on them. We only own 63 companies out of a total market in Japan of over 4,000 companies. Good leading companies in medical technology. I mean, they've got market shares for over 50%, and then in environment where we see Japan again behind in things like renewable energy, but still a very will follow a similar path to the rest of the world. So just to sort of bring it all together, James, on the last page, it's a high conviction, concentrated strategy, quite a clear quality growth tilt, good long-term track record, although definitely with volatility, and we really try to use the tools available to us investment trust structure, whether that be gearing or being able to go across the entire market cap spectrum. We do all of that from our base in Tokyo, which I think over time is becoming more and more important to be based here, simply because the coverage of this market continues to drop from the sell side. Actually, half of companies in Japan have no analyst coverage at all. So very important that we're here with a big team. And I hand it back to you.
Great, thank you. A few questions there, but I'll just ask a couple of mine first. So we were talking about China and what's going on there earlier on. To what extent does a sort of events and sort of with the economy in China affect what happens in Japan?
Yeah, well, I think, and I listening to the comments earlier, fascinating, because there obviously are concerns in China overall about regulations and laws and what's going on with the relationship with the West. But at the same time, it's a very important economy. China is Japan's largest trading partner. There are many Japanese companies with strong positions there in areas like robots, like Keyence and SMC, or medical equipment, or even Uniqlo, fast retail. These are very large Chinese businesses. So you can get exposure to that market without having to take on a lot of the kind of risks that people associate with China. Also, and this is in 2019, so pre the pandemic, the largest number of tourists that came to Japan was from China. Roughly a third of tourists that came to Japan were from China. So as that starts to recover, Japan will be a big beneficiary of that as well. Japan is very fortunate that by geographic chance, it's in the middle in Asia, where there's a burgeoning middle class who all want to do things like travel, and whether that be tourists from China or Thailand or Indonesia or Vietnam. These are countries we never saw people come as tourists to Japan from in the past, but now you really do see that. So Japan is very well placed to benefit from growth in China and the rebound in China, but you don't have the same political risks that you do with China itself.
Great, thank you. Questions popped up here, which are sort of one of the things I was thinking about. To what extent is the sort of resurgence of inflation in Japan affecting consumers and affecting the portfolio?
Inflation in Japan is a big topic because there has been no inflation in Japan for 25 years. So, it's a big deal that there's inflation. We have to put it in some kind of context because inflation in Japan, yes, it is at a 25-year high, but it is also 4%. So it has been increasing, but it is dramatically lower than what you see in certainly the UK. So it's important, and it's very interesting that wages are going up. This could be, really kind of give some impetus to the domestic economy. Wages in Japan, for context, have not gone up for 30 years. So it's very, very different from these strikes and the wages that people are asking for in the West. But that doesn't make it any less important. We're coming from a different place, and it could be quite important for driving the economy. And it's definitely a very interesting area. Inflation itself, though, we need to keep in mind that a couple of reasons why inflation has been high in Japan. One is because commodity prices were very high, and they're now much lower. So that is going to drop out. And also the yen was quite weak and is somewhat stronger anyway, at least against the dollar. So some of the things which were pushing inflation up will probably ease somewhat.
Okay, that's helpful, I think. One of the things that puzzled me was that the extent of the kind of growth sell-off in Japan, which obviously happened all over the place in the US and UK as well, but it happened here because interest rates were rising. And in Japan, that wasn't the case. And that just didn't seem to make sense to me. But now we are getting signs that maybe interest rates will go up. What will that affect? What effect will that have?
Well, you're right that in some ways it was surprising there was such a big growth sell-off in Japan when actually there was no move in interest rates at all. It was really driven by what was happening globally. So in some ways I feel like, well, we've already had a very big growth sell-off here, and the companies are trading on very reasonable valuations at this point. And when we talk about change in monetary policy in Japan, again, we're not talking about major interest rate hikes. What we're talking about for now is that could Japan maybe remove what is called yield curve control, and could it move from negative rates to zero rates? So it's a very, very different environment to that which you see overseas. And I think the main point will be that we already saw this very big sell-off in growth companies anyway. So, and is it so important if rates move from negative to zero? I'm not so sure that it is. Whereas what I think is important is that the global economy are not doing so well right now. You need companies with very strong balance sheets. And in Japan, 50% of companies have a net cash position. Well, in the West, the US and Europe, it's around 15%, 1.5. So very strong balance sheets, able to weather the storm. And maybe we'll come on to talk about this, but able to also increasingly return more funds to shareholders. And I think that actually is the big story in Japan, and why Japan is all about really exciting changes in the corporate governance sphere.
Okay, thanks. You mentioned that the yen being weak. Is there anything you do within the portfolio that manages the volatility in the yen?
No, we don't do anything within the portfolio. I can give you a view on the currency, but it's probably got around 50% chance of being right. And I think our edge is all about in knowing the companies, and that's what we want, and that's what we want to come through in what we're picking. So no, we don't.
Okay, fair enough. Now, there's the top 10. It's a fairly concentrated portfolio. Is that something that you're comfortable with for the long term, or does it feel very concentrated now relative to normal?
No, certainly. I mean, to give you a bit of the history, around 10 years ago, we made quite a conscious decision, and we worked together with the board who, I think that's a very important point, just how much we're working with the board to increase the profile of the trust and to work on the discount, the NAV discount. But we made a very clear decision that we wanted this to be an unconstrained, highly differentiated trust that should look nothing like the benchmark. And that frankly, if you just want general exposure to Japan, why not just go and buy the ETF? And core exposure, it is not really what think people are looking for. So absolutely, we should find the best companies, back them by having decent weights where we've got conviction, and also getting in those smaller companies where we can really take advantage of the undercovered nature of the Japan market. But the sizing of the positions is no, in the last 7 or 8 years, we'd have seen something very similar to what you see on here.
Okay, fair enough. Now you mentioned corporate governance, but I would have thought, are yours the sort of companies that have pretty good corporate governance anyway and have fairly efficient balance sheets, or are there still opportunities within your portfolio to get higher dividends and more share buybacks and things like that?
Well, I actually think the opportunities to get very good dividends and buybacks and returns is outstanding in this kind of portfolio, because what we tend to own is very high quality businesses with great growth opportunities, but the balance sheets don't tend to be efficient. In fact, they often are quite inefficient with poor capital allocation, which means, say, they have, in many cases, billions or certainly hundreds of millions or billions of dollars in net cash. And I would much prefer that we have a good business with an inefficient balance sheet than having to go for a company where there's going to be a major turnaround, but there isn't a good business at the end of it all. And just to give you one, if you go down the list there to the stock, which is number 5 on our top 10 holdings, Shin-Etsu Chemical. Shin-Etsu Chemical is global number 1 in silicon wafers. It's global number 1 in PVC. It's an outstanding business, but it also has a very, very inefficient balance sheet. Now, the average age of a director at Shin-Etsu Chemical until recently was 81, and very, 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 very slow to change. But that has all started to move, partly because of the quite sad passing away of the chairman, who is 96. But it does mean that we start to see changes, and we've seen the first significant buybacks from that company, and we expect much more. And a lot of if you look down the top 5 there, Keyence, Obic, Shin-Etsu Chemical, all of them, there's a lot more that they could and should be doing. So that's why I think that actually is a very good way it's a different way to play the corporate governance changes and improvements in Japan than maybe some other funds. But I think absolutely it's a very strong follow-in.
What about M&A type of activity? Is that sort of something that you expect to see?
In Japan, I think rather than M&A, what we expect to see is more management buyouts, or move more by private equity, and more moves by activist funds to try to unlock the value within Japanese companies. And I do think that this point about these changes is incredibly important right now. We've seen the start of all this happened back in 2014, when there was a corporate governance code and stewardship code put in place. And over time, we've seen Japanese companies do more, put more outsiders on their boards, try to have slightly more efficient balance sheets. But we've really seen the pace of this pick up, even this year, actually. And that's because we see activist funds, which are both foreign and, importantly, also Japanese, putting more pressure on companies. And the new thing that's happened is we now have pressure from the Tokyo Stock Exchange, also telling companies that if your price to book is under 1x, then you need to put a plan together about what you're going to do about it. And we start to see that, and we start to see more and more companies changing. And we'd expect that it's just a big opportunity in the whole market overall, and there's different ways you can play that, but that's really what we expect, more than significant M&A. In Japan overall, we'll just see some companies start to disappear because the founders are getting much older. So that's much more I expect to see. Okay.
Valuation. How do you work valuation into your sort of stock selection process, and how do you sort of judge whether something's attractive for you valued or not?
Yeah, we on this slide that you've put up just had the 1 year forward PE because that's how people conventionally look at this kind of thing. But that's actually not how we do things. We look at something called a 5-year expected return. And what that basically means is we're going to look at how are earnings going to trend, going to be over the next 5 years? What earnings growth do we expect from there? And what multiple do we think that the market will put on those earnings in year 5? So everything that we're set up for is to really help with taking that long-term view, which, you know, with a turnover of under 20%, is I think what you can see us doing in the trust.
Okay, that makes sense. And which sort of measures do you look at? So is it sort of done on a PE basis, or is it price to book again, or?
This is all done. That will be in year 5. We put a PE multiple on those earnings. We'd also and the multiple we would change would be affected by things like, well, how do we see the industry outlook and competitive advantage? But we can reflect that in terms of applying, for example, using a lower beta, for example, for stocks which have premium and quality ratings as opposed to trading, or companies with very strong balance sheets, for example.
Okay. There are a few questions about sort of gearing policy and what drives that. So do you want to talk us through what you've done with gearing over the past year or so and where it is now, please?
Well, the decision on gearing is a function of, can we find strong enough bottom-up opportunities? We absolutely do find that. I mean, the market, just so you know, the market overall is trading on around 1 standard deviation cheap on both price to earnings and price to book if you look over the last 20 years or so. Perhaps not surprising that we find lots of opportunities right now. Right as we speak, the current level of the gearing is 14%. It's a little bit up on a year ago when we've been 12.5%, but still it was around, I guess, roughly the same level, slightly up, because we found some good opportunities. Okay.
Thanks. Now, back to sort of the portfolio again. So Keyence is 9.3% of the portfolio. Is there a kind of maximum size that it could get to?
Yes, we wouldn't be more than 7.5% overweight any stock. In fact, in the first quarter this year, we actually reduced the weight in Keyence precisely because it hit that limit on where we go. And when we buy a starting position, the maximum we'd be overweight is 5%. It's only if the stock performs well, and we can, you know, I think it's very important that we won't run winners to an extent. And so we can go up to that 7.5%, but then that is a hard limit on how big the position can be relative to the benchmark.
Right, that makes sense. Okay.
I think I like to always think that the portfolio is unconstrained, but it is not uncontrolled. Mm-hmm.
Yeah. Okay. The couple of questions, I think, they're sort of comparing the Japanese market to the US one, and obviously the valuation is extremes, you know, between one and the other. Is there anything that you think it would help it converge?
I think if we really can, and I do think we're seeing this, I think it's actually a great time to have this call, that we do see this real improvement in momentum behind what companies are doing in Japan in terms of improving the efficiency of their balance sheet. So that's important. I think that a lot of people simply don't look at Japan or haven't looked at Japan for a long time. It's helpful that Warren Buffett has been here recently and just said again that not, you know, he's going to look to make more investments in Japan. So these are helpful things, but there are some really clear anomalies in terms of valuation. If you look at the deal that Microsoft was trying to do, or is still trying to do, to buy Activision Blizzard, which is around a $75 billion deal, you know, they could have bought all of Nintendo for less than that and got a lot of the net cash in the balance sheet. So even when you look at similar types of companies in Japan, they trade at really substantial discounts to what you see in the rest of the world. I also think that, you know, if you look at I know this debate comes up a lot around the UK, and you can say, well, what about BP and Shell versus Exxon? They have big discounts. But in the case of Japan, I think you do get companies that you can't buy anywhere else in the world. Like, for example, in automation and robots, all of the global leading companies are in Japan. So you need to buy them here, or in these medical equipment areas. The winners are in Japan. They're the ones that are taking share, global number one, got strong following. So, I think that Japan's been an out of favor market for a while, but there's a big shift going on, which is, I think, quite under-recognized in terms of the corporate governance changes. And there's outstanding companies here, and outstanding companies here in areas which you actually can't get exposure to in other markets.
Good. Thank you very much for that, Nicholas. I think that's quite a good roundup of where the fund is, and good luck with it going forward. Enjoy the rest of your holiday, and
thank you.
We'll talk to you again in a few months' time, maybe.
Perfect. Thanks a lot.
Thank you. Cheers. Right, we will be back next week, and we're talking to an investor in the space, Kamal from Canaccord Genuity. It's always interesting to find out what people are buying. I think that's sort of more institutional buyers. Don't forget, our property investment conference is coming up. So if you haven't signed up for that, I think the time to do so now. And then we've got an interesting one on the 19th of May, which is Credit European Renewables, which is one of these funds that's been a bit out of favour recently, and maybe for no good reason, but it's worth listening to the story, we think. Anyway, have a good week, and we will be back again next time. Thanks. Bye-bye.